Hey guys, welcome to another video. This is Options 101. Today we're going to be talking about how options work, and this is my second video in a series of videos where I teach you about options. In the previous video, we talked about what options are and why should we care. Definitely check that video out before watching this one if you want to get the basic understanding of what they are. I'm using TD Ameritrade's education course, which is one of the best resources I've found. I will be going through their lessons and then breaking it down as we go along. Let's begin. How options work. Now it's time to dig into what an options contract is. Let's start with the basic definition. An options contract is a derivative investment that gives the owner of the contract the right to buy or sell a specified number of shares of a stock, ETF, or another predetermined underlying at a certain price before a date. And we'll talk about what a derivative investment is and what is an underlying. There's a lot in that definition. To make things clearer, let's walk through an example. Let's say it's June and XY stock is currently trading at $49 a share. So you can see the stock is going up and down, but around June, as of today in this example, it's at $49. Trader A thinks XYZ will go up in the next month, and Trader B thinks it will go down. Trader A could simply buy the stock, but she's not interested in building a position. So she decides to use options to speculate on bullish price movement without owning the stock. Options are derivatives, which means their value is derived from the value of something else. In particular, the options price is derived from an underlying. So stock is the underlying, and options derive their value based on the price of the stock. So option depends on the stock for its price, versus the stock itself has intrinsic value and it's very clear what the stock is worth. Options are also leveraged instruments, which means investors can potentially earn higher returns or experience greater losses using relatively small amounts of capital. Therefore, options can be an alternate way for Trader A to speculate on the price movement of a security. Leverage is what makes options so enticing. With a smaller amount of money, you control a lot more shares, you control a lot more capital, and that's what leverage means. And on the flip side, because you're using a smaller amount of money to control a larger amount of stock that's worth a lot of money, you could also lose a lot of money. So Trader A buys an options contract from Trader B. That gives her the right to buy XYZ at a certain price known as the strike price, and before a certain date known as the expiration. The strike price and the expiration are specified in the contract. This particular contract has a strike price of $50 and expires in 1 month. So these are very, very important, and we can see them in bold. Contract gives one of the people, Trader B, the right to buy. We have to know what the strike price is and when it expires. These two things definitely keep in mind as we go on. They are in every contract because the strike price is the number we'll need to keep in mind as we watch the stock go up and down. The strike price is what's going to determine whether this contract expires in the money or out of the money, and we'll talk more about that later. In exchange for that right, Trader A pays Trader B a premium, options lingo for price, that's just how much it costs, which for this XYZ option is $2. A standard options contract controls 100 shares of the underlying. One contract always controls 100 shares. Take note of that. The total amount an investor has to pay for a single options contract equals the price of the option, $2 in this case, times the options multiplier, or $200 plus transaction costs, aka contract fees. So Trader A pays Trader B $200 to buy one contract. It's important to understand that Trader A hasn't actually bought any shares of XYZ yet. She has only bought the right to buy. That's why options are often talked about as if they are coupons. You don't actually have the product yet, you just have a coupon. You still have to pay for the shares, but the coupon just locks in your price. For Trader A to have the right to buy XYZ at the strike price, someone must be willing to sell at that price. That's where Trader B, or the option seller, comes in. Trader B collects the $200 in exchange for promising to sell XYZ at $50 anytime between now and the expiration date in July, because she's obligated to sell if Trader A exercises her right to buy before expiration. Notice the difference. The buyer has the right to buy, and the seller has the obligation to sell. Trader A doesn't have to exercise her right. If she doesn't, Trader B won't be obligated to sell. But if Trader A does exercise her right, Trader B must fulfill her end of the deal. Now, this may seem a little strange. Why would the right to buy have value? This is also very important. Remember that if you are buying a contract, somebody has had to have sold it to you. And when a buyer is bullish on a position, usually the seller would be bearish on a position. They both believe that they are making the right move in this situation, but generally only one of them will win. So in this specific situation, it is kind of a zero-sum game. There will always be a winner and there will always be a loser. So it's up to you to try to make the better call than the person you are either buying from or selling to. Let's look at some possible outcomes of our example. Let's assume that before the option contract expires, the price of XYZ jumps from $49 to $53. Trader A could exercise her right and buy 100 shares from B at the strike price, a much more desirable price of $50. Therefore, this right allows Trader A the ability to purchase a stock for less than its current market price. In this circumstance, it's easy to see why Trader A would be willing to pay $200 for the XYZ option. We can all appreciate the value of paying less for something that's more expensive. Look at this graph. The strike price was at $50. The contract Trader A bought gave her the right to buy it at this price point, even though the market value was at $53. So without this coupon, and she was trying to buy 53 shares of this stock, it would have cost her $5,300. But because she had a suspicion that this stock would continue to go up, she saw value in this coupon and bought it for $200. So her total cost of ownership of the stock would be the $50 strike price times 100, $5,000, plus $200, which was the price of the options contract. So she spent $5,200 to own 100 shares of this, versus if she didn't have the coupon, it would have cost her 53 times 100 or $5,300. So this $200 coupon actually saved her $100. On the other hand, let's suppose XYZ. In this situation, the option seller didn't make the right call. We'll come back to that later. If person A is getting it at a discount, person B is selling it at a loss. Winners and losers, we'll get into the details of that later. On the other hand, let's suppose that XYZ falls from $49 to $48 before the contract expires. Trader A could still exercise her right to buy at $50, but why would she want to pay more for something she could buy on the market for cheaper? In this situation, the XYZ option would likely go unexercised and expire worthless, leaving Trader A out of her $200. So in this alternate world, the value of this stock does not go above her strike price. Rather, it stays very, very low. So her options contract gave her the right to buy 100 shares of this stock at $50. $50 is the discounted rate she wanted to lock in. But now the price is actually $48. So if the actual market price is lower than what the coupon allows her to buy, what is this coupon worth now? Essentially nothing. That's why it would go unexercised and expire worthless, because the coupon to buy at a cheaper price, it doesn't have value when the actual price is already lower than the rate the coupon locks in. Now let's look at it from the seller's perspective. In both cases, as the seller, you always get to keep the $200 premium she received for selling the option no matter what. This is important. Note that down. You always get to keep it. That will never be taken away. However, if the stock price is higher than the strike price at expiration, the seller will likely have to sell the stock, called assignment, for less than it's worth. If the seller didn't already own the stock, she would need to buy the stock in order to deliver. She would then lose the difference between the strike and the market price, which would cut into her $200 profit. This would be a less than ideal outcome for B. Therefore, the seller hopes that the contract expires worthless because she'd keep the full premium. In this previous case where the stock value went very high, remember the buyer gained $100 because she managed to buy this at a discount. But what happened to the seller? The seller had $200 in premium, but what she had to do is buy it at its current market price, which was $53. So she had to pay $5,300 to get these shares, but then sell it to the buyer at only $5,000. So the seller's net loss is $100 because $5,300 for the amount he bought, he sold it at $5,000, which is so far a net loss of $300. But remember, he got a $200 premium, so the difference between $200 and $300, he's down $100. Buyer gained $100, seller lost $100. This example shows what would have happened if trader A wanted to exercise her right to buy, a process known as exercising the option, and waited until expiration to do so. But that's only one possible outcome of an options trade. Many traders buy and sell options contract long before expiration without ever intending to exercise the right to the underlying. Keep in mind, there is no guarantee of being able to close an options position, as there are circumstances where the quote on an options contract can actually be zero. So in these two examples, we reached the expiration of the contract, but that is actually not always the case because the stock prices are always fluctuating. The value of these coupons are always changing, and options traders actually trade them like stock. Options contracts fluctuate in value and can often be bought or sold before expiration for a profit or loss. Remember the premium we introduced earlier? Like a stock price, the premium is constantly changing in value. Your options contract becomes more or less valuable. Because our examples focused on the value of the options premium at expiration, options pricing may seem simple. However, pricing is more complex when you consider how it would gain or lose when it's days, weeks, or months from expiration. This is a very important thing to understand about options. Options pricing is different from stock pricing. A stock's value, it only comes down to one factor, its price. The options premium, however, is influenced by multiple factors. The value of the underlying stock, of course, but also things like how much time is left until expiration and the perceived risk of the underlying, also known as implied volatility. So as you can see here, pretty similar to a stock, you can buy an option at a certain amount of time for cheaper and sell it, hopefully at a profit later. This could happen in a time period of days, months, years, but even minutes and seconds. Options are extremely volatile when you compare them to stock because any $1 movement in stock results in a much higher movement in the options. That's what leverage is, when less money, again, controls more money. So a little bit of movement results in big swings in options. Let's go back to our example to illustrate. Suppose that a week into the trade, the price of the underlying stock spiked, let's say from $49 to $52. With each dollar that the price goes up, the value of the option increases. Let's assume by the time the underlying stock reached $52, the option increased from $200 to $250 per contract. Trader A now holds an options contract that's worth a lot more than it was when she bought it. She could sell this contract to someone else and profit from the price appreciation. She'd be buying low and selling high. The example, like I said before, buy low, sell high, just like a stock, you profit the difference. Conversely, if the premium fell from $200 to $150 per contract, Trader B could buy the contract back at this lower price, capturing the $50 difference. This would be a case of selling high, then buying low. The reverse could also happen. You could lose money just like in stock trades. It's important to keep in mind that little price move in the underlying can result in a big percentage move in the options premium, just like I said before. And a big move in the underlying can result in an even bigger percentage move in the options premium. This is leverage, using small amount of capital to control a much larger amount of the underlying security. Using a relatively small amount of capital to control a much larger amount of the underlying security magnifies both gains and losses. Leverage can benefit if it goes your way, but a burden if it does not. Leverage is why options are risky. Remember that. Leverage is why options are risky. In stock, it's very clear. If the value of the stock goes down by $5, you've lost $5 if you decide to sell that stock and realize that loss. In options, it's not so simple. Some options, the stock drops $1, you could lose 100% of your contract in a second. And the reverse is true. If the stock goes up $1 or $2, you could get a 300% return on your contract. That's why it's so enticing and that's why it's so risky. Whenever entering a trade, it's important to consider the potential risks, returns, and your probability of success. You should always know what you stand to lose and be willing to accept it. So let's see if you learned anything. We'll go through this quiz and pause the video after I ask the question and see if you can get the right answer. Which of the following statements best describes an options contract? It's a debt security that allows traders to buy 100 shares at a certain price whenever they want. It's an equity security whose value is derived from company fundamentals. It's a derivative security whose value is derived from an underlying. Pause. Do you know the answer? It's a derivative security whose value is derived from an underlying. When the underlying moves, the value of the option changes. An options contract has a $13 strike price, a $125 cost per contract, and expires August 20th. How much is the options premium? What do you think? If the whole contract costs $125 and you know that a contract controls 100 shares, then the options premium is just the total cost of the contract divided by 100. So for every one share, the premium is $1.25. Which of these statements describe option sellers? Select all that apply. They have the right to sell shares at a certain price by a certain date. They collect the options premium. They are obligated to buy or sell shares at a certain price by a certain date. They pay the options premium. Let's go through it. They have the right to sell shares at a certain price by a certain date. Do they have the right? They actually don't have the right. They're selling away their right. They collect the options premium. That is true. They do get money for selling. That's what they get for essentially giving a right away. They are obligated to buy or sell shares at a certain price by a certain date. This is key. They don't have the option to do anything because they're getting paid to give away that right. The buyer is the person with the right to sell or buy shares. Sellers are obligated to buy or sell shares. They pay the options premium. Incorrect. That is for the buyer. So there we go. How did you do? If there are parts you still didn't understand, feel free to just go through the video again. I'm going to be going through this full series and it was so helpful for me. I just wanted to share it. If you have a TD Ameritrade account, you can actually also just take this course. It's really good and it gives you exactly the information you need. I think it's just helpful to have somebody give examples and give clarifying points as you go through it. Please follow me if you want to learn everything there is to learn about options and also see my trades. This channel is both educational and also a diary for exactly what I'm doing. You'll see my portfolio, you'll see the trades I make every week and watch what works and what doesn't and watch me evolve as a trader live. And this is Green Knight Trading, where Squires become Knights. Thank you so much for watching and I'll see you all next time.